Just hold long-term like Buffett and you'll get rich. You've heard this advice a million times. Every finance book, every YouTube guru, every LinkedIn post from that guy who just discovered compound interest. But here's the thing that nobody talks about. If long-term investing is so simple, why can't 99% of people actually do it? Today, I'm going to show you Warren Buffett's $171 billion secret weapon, and I'm going to explain why you can literally never replicate it. Let's get into it. So let me be clear about what we're not doing today. We're not talking about which stocks Buffett picks. You can find that in his 13F filings. They're public. We're talking about something far more important. Why he can hold these positions for 30, 40, even 50 years, even when they drop 20%, even when they drop 40%, even when the entire market thinks he's lost his mind. Spoiler alert, it's not patience. It's not discipline. Those are symptoms, not causes. The cause is something called insurance float. And once you understand it, you'll never look at Buffett's success the same way again. Value investing is simple. Buy great companies, hold forever. Buffett's secret is patience and discipline. Anyone can invest like Buffett. This is the story Wall Street loves to tell. It sounds inspiring, it sells books, it makes great headlines. And look, I get it. It's a comforting narrative. It suggests that with enough willpower, you too can become the next Oracle of Omaha. But is it actually true? Let's look at the numbers. According to research from Dalbar, a firm that's tracked investor behavior for decades, from 1996 to 2016, the average equity investor underperformed the S&P 500 by about 4% per year. 4% every single year for 20 years. Compounded over time, that's a difference of over 50% in total wealth. And here's the kicker, this is not a stock picking problem. Most of these investors owned perfectly fine funds. It's a timing problem. People panic sell at the bottom. They FOMO buy at the top. They make emotional decisions at exactly the wrong moments. So the real question isn't what stocks does Buffett buy? The real question is, why can Buffett stay calm and hold when everyone else is panicking and selling? Okay, let me explain this with a simple example. Let's say you buy car insurance for $1,000 a year. Does the insurance company take that $1,000 and lock it in a vault waiting for your accident? Hell no. They invest it. They put it to work in stocks, bonds, real estate, whatever they think will make money. And that gap, the time between when they collect your premium and when they actually have to pay a claim, that's where the magic happens. That pool of money is called float. It's basically a loan from policyholders that the insurance company gets to invest. In 1967, a young Warren Buffett bought a small insurance company called National Indemnity for $8.6 million. At the time, their float was about $19 million. Fast forward to 2024, and Berkshire Hathaway's combined insurance float is now $171 billion. Let me put that in perspective, that's roughly the GDP of Ukraine, just sitting there waiting to be invested, and it grew 8,000x. Not a typo, 8,000 times. Now here's where it gets really interesting. A group of researchers from AQR Capital Management wrote a famous paper called Buffett's Alpha. They wanted to understand what's Buffett's actual edge, and one of their findings blew my mind. The average cost of Berkshire's insurance float has been about 2.2% annually. That's 3 percentage points below the average treasury rate during the same period. Think about what that means. Buffett isn't paying to borrow this money. In real terms, adjusted for the risk-free rate, people are paying him to hold their capital. Now let's compare that to what you get if you want leverage. Buffett operates with about 1.6x leverage on average. You could use 1.6x leverage too. Your broker would be happy to let you. But his leverage is basically free. Yours costs 8 to 12% per year and can be called at any moment. Same leverage ratio, completely different outcomes. Let me show you how this plays out in real life. 1973-74, the stock market crashed nearly 50%. Oil crisis, Watergate, economic chaos. Buffett spotted the Washington Post company. He ran the numbers and believed the company was worth $400–500 million. The market cap? Just $80 million, trading at less than 20 cents on the dollar. He started buying at around $6 per share, and after he bought, the stock dropped another 25%. Now imagine if you had bought on margin. Down 25% on a leveraged position? That's a margin call. Your broker liquidates your position. You're out of the game. Thanks for playing. But Buffett, he just kept buying. His total investment, about $11 million. The result? That stake eventually grew to over $1 billion. That's approximately a 100x return because he could hold through the pain when everyone else was forced to sell. Fast forward to 2008, the global financial crisis. Lehman Brothers just collapsed. Credit markets frozen. The world was on fire. Everyone was selling. Everyone was desperate for cash. Everyone except Warren Buffett. He had $50 billion sitting in cash and treasury bills. And while everyone else was scrambling, he picked up the phone and started making deals. His deal with Goldman Sachs, September 2008. $5 billion investment in preferred stock, 10% annual dividend, that's $500 million per year, guaranteed, plus warrants to buy common stock at a bargain price. By the time Goldman repaid him, total profit over $3 billion. Now here's the question, could you have gotten that deal? Absolutely not. This was a private placement, not on any exchange, no ticker symbol. Berkshire got a phone call because they had the cash and the reputation. You would have been buying Goldman common stock at market price. With no guaranteed dividend, no warrants, no downside protection. Same company, completely different terms. That's what cash and leverage advantages look like in practice. Okay, let me be brutally honest with you about the gap between you and Buffett. Number 1, the leverage cost gap. Buffett pays somewhere between -2% and +2% for his leverage. You pay 8-12% at most brokers. That's a 10 percentage point difference. Every single year. Number 2, forced selling risk. Buffett never has to sell, ever. His capital is permanent. You face 3 constant threats: margin calls, stock drops, broker demands more collateral, life happens, mortgage, medical emergency, kids' college tuition, psychology. Can you really watch your portfolio drop 40% and just do nothing? Studies show most people can't. They sell at exactly the wrong time. Number 3, tax efficiency. Corporations get a 50% dividends received deduction. Berkshire, as a holding company, keeps more of its dividend income. You pay full freight on dividends. Same income, different tax treatment. Number 4, deal access. Buffett gets 10% preferred shares plus warrants in crisis deals. You get to buy common stock at market price. No negotiation. Take it or leave it. Now here's the real mind blower. Those AQR researchers I mentioned, they ran a factor analysis on Buffett's returns. They controlled for value factor, quality factor, low volatility factor. And when they did that, Buffett's alpha became statistically insignificant. What does that mean in plain English? His stock picking can be explained by systematic factors. You could theoretically replicate it with factor funds. What cannot be explained or replicated? His leverage structure. You can copy his 13F holdings. They're public. But you cannot copy how he's financed. And that's where the real magic is. So what do you do with this information? First, stop falling for the "just invest like Buffett" clickbait. It's like watching Lewis Hamilton win a Grand Prix and thinking, "I just need to stay calm like him." Bro, he's driving a $15 million car with a team of 1,000 engineers behind him. You're in a Honda Civic. The car matters. The tires matter. The pit crew matters. The track matters. Being calm is necessary but not sufficient. So what can you do? 1. Index funds. Low cost, diversified, no stock picking genius required. You get the market return minus tiny fees. 2. Dollar cost averaging. Takes the timing problem off the table. You buy consistently regardless of price. You're not trying to be smart, you're trying to be consistent. 3. Build an emergency fund. This is critical. Make sure you are never a forced seller. 6 to 12 months of expenses in cash means you can hold through downturns. 4. Skip the leverage. Unless you have access to cost-free capital, which you don't, leverage will hurt you more than help you in the long run. Look, it's not as sexy as invest like Buffett, but it's a strategy designed for your car on your track. And that's what actually matters. Here's the truth nobody wants to tell you. Warren Buffett's success isn't just about picking good stocks. It's about structural advantage. Insurance float equals $171 billion in cost-free leverage. No margin calls, no investor redemptions, no forced selling, below risk-free borrowing costs. That weapon? You can't buy it, you can't build it, you can't replicate it. So instead of chasing the Buffett dream, build a strategy that works for your reality. Understand your actual advantages and disadvantages. Invest accordingly. If this video gave you a new perspective on investing, hit that subscribe button. I make videos that challenge conventional wisdom and dig into what's actually true versus what sounds good. And drop a comment. Have you ever fallen for the "just hold like Buffett" advice? What happened? I'll see you in the next one.